let's start the clock. Little fresh fodder for hawks in the FOMC minutes. Does that mean that they were dovish or just adding nothing new?
I've seen both interpretations out there. Bloomberg Intelligence think they're a little bit more hawkish. Generally, my team seems to think they were slightly dovish at the margin. But either way, these were stale minutes. Since then, we already had a monster inflation print. And even the retail sales print we got yesterday kind of emphasized the story that inflation problem is even bigger than they were talking about a month ago. So I'm surprised that yields are generally trading lower. And I think that says something about this market. It was very interesting. There was no reaction in the wake of retail sales immediately. No attempt to push yields higher. So I think this is a market that has done that front-end yield story a little bit too far, too fast, and it's hard to push it much further in the short term.
OK, and is it also a market whose direction is being dictated in the very short term by geopolitics and concerns around geopolitics? We certainly have a lot of Western voices not very trusting of Russian commitments to pull back troops. We have Russian media making a big deal out of unconfirmed reports of ceasefire violations at the border, although the OECD says that this happens pretty often. The market is responding to these kinds of lines and taking a risk-off view.
They are responding, but I think that says more about the positioning in the market and the vulnerability of the market than actually how seriously they're taking these kind of new reports. And as I said, I point to oil markets. Oil prices aren't higher on the day. And that's because we've again had a market there that's traded bullish oil for a long period of time. This is a market where positions are getting squeezed. So the market was long oil, and therefore oil's a little bit softer this week. The market was playing for higher short-end yields, and therefore that's the market that is coming down this week. Yes, we are reacting to geopolitical tensions, but it's important to emphasize that speaks to the sentiment in the market more than the strength of conviction in the reports we're hearing.
Somewhere where we are seeing yields moving to the upside and a sell-off in bonds is in the long end of the Japanese curve. And you touched on this a little bit earlier, but take us through what's changed here, Mark. I mean, I know that other parts of the yield curve are controlled over in Japan, the yield curve control policy from the BOJ, maybe not at the long end. And what has changed? What has triggered this particular move?
Look, I think this is really interesting, mainly because I haven't been able to care about the JGB market in years. It's normally boring, it's dead, and it's getting really exciting. As you say, Anna, it's because the 10-year is being controlled. This is where you kind of express the angst in terms of global market yields. And it is about global yields pushing higher here. I think many foreigners are getting sucked into pushing 30 years. They're trying to test the BOJ. I have learned through losing money in the past, do not try the short rates trade in the JGB market. And I think people are going to suffer from the same problem again. Ultimately, the local Japanese market is going to love these higher yields they can get at the long end. This is a very, very low volatility market. And until volatility calms down elsewhere, they might be tempted to take these lower yields, but higher than previous, then chase the volatility in foreign bond markets.
Mark, how we all benefit from your experience. Thank you very much for thoughts so far. You can get up-to-date analysis from the Markets Live team. MLIV GO, that is the function to use on your terminal.